Right now, half the internet is screaming that artificial intelligence is a giant financial bubble, and the other half is swearing it's the greatest technological leap. But both sides are arguing over the exact same thing: consumer demand. The problem is that demand metrics like user growth and adoption rates are incredibly noisy. They are easily manipulated by public relations narratives, or worse, they are manufactured by money moving in closed circles within the tech industry itself. This cyclical flowchart shows how that money makes its rounds. Follow any arrow and you'll see the exact same loop. NVIDIA funds an AI startup like OpenAI. OpenAI uses that money to pay cloud computing providers like Oracle, and Oracle takes those same dollars right back to NVIDIA to buy more chips. And every single time that money changes hands, it gets counted again as brand new revenue, artificially inflating the appearance of massive end-user demand. To find the truth, the world's most successful investors ignore demand entirely. For over 200 years, they've tracked financial bubbles by looking at the exact opposite metric, the supply side. The supply side tells a staggering story right now. This year alone, the biggest tech companies in the world are on track to spend around $725 billion on artificial intelligence infrastructure. That massive price tag goes directly into physical hardware. We are talking about hundreds of thousands of highly specialized computer chips stacked in endless rows of servers, housed inside massive, climate-controlled data centers. You can fake user growth with clever accounting and aggressive marketing, but you cannot fake $750 billion in physical hardware. This upfront capital creates a specific economic trail, one that reveals the real story of the industry long before the demand metrics ever catch up. The mechanics of this crash were laid out in the 1700s by economist Adam Smith. It's a predictable economic framework, modernized today as the capital cycle theory. Money blindly floods into any new industry showing high initial returns. We saw the first stage of this cycle, the flood, play out perfectly during the British railway boom of the 1830s. Steam locomotive technology arrived, the initial returns looked incredible, and capital came flooding in from every corner of society trying to secure a quick fortune. That massive influx of money triggers the second stage of the cycle, the boom. Flush with cash, companies stop building what the consumer actually needs and start laying down unnecessary infrastructure just to keep their share prices climbing. Telecom companies fell into the exact same trap in the late 90s. They buried 80 million miles of expensive fiber optic cable under oceans and across continents, only to realize that 85% of it would sit completely unused. That $725 billion AI spending spree sits squarely at the peak of this boom stage. Right now, tech giants are racing to build server capacity far faster than any actual software can utilize it. The technology changes, but Adam Smith's economic law remains completely unbroken.
A massive flood of capital guarantees brutal competition, and that competition inevitably destroys the profit margins for every single company involved. That margin destruction forces the third stage of the cycle, the collapse. The massive oversupply of physical infrastructure finally crushes the very financial returns that attracted all those investors in the first place. We are already seeing the first major cracks form in the AI sector. Last year, OpenAI's internal financials leaked, revealing that despite being the most talked about company on Earth, they are bleeding cash at a terrifying rate. This bar chart comparing OpenAI's total revenue to its marketing spend highlights the specific problem. Out of their entire revenue, they had to spend 44%, or $5.7 billion, on sales and marketing alone, just to fight off competitors and keep people using their product. When the return on investment collapses that quickly, it creates an incredibly fragile stock market. We are left with valuations priced for absolute perfection, where a single minor slip in projections becomes instantly fatal. Look at this financial line graph of Broadcom's stock price to see how fragile this gets. They missed their forward earnings guidance by what amounts to a rounding error, and investors instantly erased $300 billion of market value in a single trading session. After the collapse, we enter the final stage, the inheritance. The original companies that laid down the infrastructure go completely bankrupt, but the physical assets they built remain perfectly intact in the real world. A financial collapse among today's AI leaders leaves behind a global network of heavily discounted data centers and high-end chips. This inherited infrastructure provides the low-cost foundation for whoever arrives to build the next version of the economy. In business, the end of every tech cycle comes down to a ruthless historical archetype. The pioneers get the arrows, and the settlers get the land. The pioneers are the first movers. They take on all the upfront risk. They bleed through their cash to lay down the initial infrastructure. They fight the early legal battles, and ultimately, they die. The settlers are the second movers. They simply wait for the dust to settle, walk into the wreckage of the crash, buy up all the distressed assets for pennies on the dollar, and quietly take over the market. Early search engines like AltaVista and rideshare apps like Sidecar bled out fighting in court and burning cash to educate the public. They died entirely so that settlers like Google and Uber could step in and thrive on their foundations. Right now, the staggering upfront capital required to build out language models and server farms has forced the current AI giants squarely into the doomed role of the pioneer. While the public debate focuses on whether AI can automate white-collar work, the capital cycle points toward a more immediate corporate reality. We are watching which current tech giants are burning through their reserves to build their own replacement, and which settlers are waiting to buy that infrastructure for pennies on the dollar.